Well, let's welcome our guest host for this hour of Squawk, Phillip Blumberg, who is Chairman and CEO of Blumberg Capital Partners. Welcome. Nice to have you here and to see you in this side of the world.
Nice to be in Singapore.
You know, we were talking before. We started the week with so much euphoria on the back of the Yuan currency changes. This suggested the global recovery story might be intact. A day later, the market's now worried again. Give us a sense of the optimism that you're feeling or the sentiment you're feeling about the markets right now.
Well, I think the markets are acting in a very short-term manner. We're looking at rise in markets or speculation markets based on a mere impact on imports, exports during this political season. It's clearly a politically motivated desire to see the yuan float, therefore create some perhaps a little stimulus in the Western economies. Long term, though, I think it bodes for much higher commodities costs. When the biggest commodity buyer in the world has a bigger currency, we're looking at costs going up. And if you recollect, before the huge financial crisis overshadowed everything, the big story in the world was the cost of commodities moving up as China and other emerging markets geared their growth up.
That's a really interesting point, Philip, and I think that's one that's overlooked when you look at the whole debate on currency appreciation. From the US perspective, I'm really curious to know, isn't it a case of be careful what you wish for? Because if we do see appreciation, that's going to make Chinese goods exported to the US more expensive for US consumers, and that could potentially upset the recovery.
See, I agree totally with what you're saying. I think there's a simple one-word answer: midterm elections. And there's a need right now to do anything possible to stimulate the economy. But over the long term, this pressure is unwise and I think inappropriate. The other issue is, as China's growth continues, its consumption of commodities, and it's fair to say the emerging markets' consumption of resources are going to continue to accelerate. As those currencies rise, they're really going to be able to outbid Western economies whose currencies are either flat or lower. So I think it's, in the EU's case, its pressure is very short-term and very political, not sound economics.
I'm picking up on the tone that you're more on the inflation side of the trade rather than deflation.
Yes.
How widespread will the problems be when it comes to rising prices?
Well, here's our problem. We're already seeing PPI increases, and that's where it comes from. So if we have producer price increases already, cost of goods it's already foreboding for cost increases. Those increases in a down economy is not a very good timing. So I think in the long term that China's reluctance is certainly understandable. Its people don't want to see disruption, and frankly, it doesn't want to take fixed rate investments and see them deflated in value. But for the rest of the world, it's a big impact, and it will continue to be a big impact. I know they will gently raise it. They won't do so disruptively. But at the same time, that raise will have a big impact, I think, in U.S. inflation. It's one of the reasons we like the real estate sector, because it is inflation indexed. But the reality is, if you're in anything that isn't that's long-term fixed rate, you're going to have a problem.
When you say real estate investments, you mean purely U.S. or do you mean how broad-based are you thinking?
Well, I think it's interesting you ask that, because the reality is, if you're purely U.S. or purely any country, you're not taking into account the diversity of the global market. In 2000, for example, although we did this hedging in the U.S., we hedged against energy prices by buying heavily in Houston. That turned out to be a very profitable deal for us, because as energy costs went up, we sold our non-energy market buildings first, our energy market buildings second, and we were able to both take advantage of the real estate market influences and the hedge. In this fund we are now launching, which is a large billion-dollar fund for global investment, primarily it'll be in the U.S., 70%, but the rest of the fund will be investing in emerging markets, Brazil, the Middle East, elsewhere, where we do expect to see commodity price rises. Bear in mind, energy is our number one cost in the office building business. So we're hedged against energy, and if we're hedged against commodities, we see that positive hedge as it did before.
When you say you hedged against energy prices, Philip, at what level? Because we're around the mid-$70 barrel range once again. Was it around the mid-70s or
yeah, no,
or higher?
We hedged in 2000. 2000, when Houston was a capital deprived market, we could buy low. Houston didn't rise until 2006 to 2008, but if you remember, that's when energy prices were cresting. Our hedge is very direct. It's right into property and markets that move very clearly with the underlying commodity, in this case energy. We can continue to look at hedging in energy by investing in markets like the Middle East, the Gulf, and in Brazil. But if you think about an office building, it's almost like a barge of commodities. It's steel and concrete, petrochemical and glass, all products which are going to be going up, as they did before, at about 12%. So if we're looking at 12% annual increase in those costs, you've got already an uplift to take advantage of commodity price inflation. The second is our office rents are indexed to inflation, so that's a double inflation hedge. In that sense, I think we're very comfortable with a small portion of our portfolio, 30%, being in commodities and energy markets.
Okay, listen, Phil, we'll get back to you for a lot more coming up in just a second. Phil Blumberg there.